Good afternoon and welcome to what I hope will be an informative Agora Café. On today's call, we have three presenters. We have Keith Leslie, a portfolio consultant, who's going to be reviewing both the benefits of investing in a professionally constructed model portfolio and the outcomes that have been achieved. We're also joined by Greg Valliere, AGF's Chief US Policy Strategist, and he's going to provide some perspective on the outcome of the US election and what that might mean, including insights on trade and tariffs. Last but not least, we're joined by Auritro Kundu, who will serve as a portfolio manager of the AGF Investments U.S. Global and Canadian Growth Equity Strategies. So we're going to start at the top level. We're going to drill down into the US and then down into specific strategies. So going within those ones that are within the managed solutions. I'm going to introduce each speaker before they speak, and then depending on the time, we will either do questions at the end of each section or hold them for the end. If you have any questions, I will try to include them. I think the easiest is if you email them to me directly at mprobin@agoracorp.ca. So up first is Keith Leslie, who's going to provide the overarching view. Now, Keith is a graduate of Western University, and he's been with NCM Asset Management for over 20 years. And as an early adopter of factor-based investing, Keith created the quantitative analysis team at Beset Asset Management. At NCM Asset Management, he uses statistical techniques, evaluation tools, and modeling to make investment decisions. He actually measures any factor that he can find to measure it numerically, and some say that he tortures the data until it confesses. His favorite advice is from Benjamin Graham. The essence of portfolio management is the management of risks, not the management of returns. So I'd like to welcome Keith Leslie to today's call and turn it over to you, Keith. Thank you very much.
All right. Well, thanks, Mark. I appreciate everyone taking the time. As Mark mentioned, I'm Keith Leslie from NCM Asset Management. And really what I wanted to do today is start by walking you through why we believe model portfolios are important. And they really should be an integral part of your business from both from a client perspective, a compliance perspective, and more importantly, from a business perspective. I'll briefly talk after that. I'll briefly talk about how we put our models together and the reason behind we did what we did, and then we'll sum it all up at the end. So why use model portfolios, or why use a model portfolio? I guess the answer is we spend a lot of time putting these together. And myself and my team, we spend hundreds of hours designing, testing, changing, retesting our models, and really we wanted to create ones that would actually help investors achieve their financial goals over time. We really, I'll get into this a little later, but we are really looking for consistency of returns rather than maximizing returns. Turns out it becomes one and the same, but what we're looking for is consistent first and second quartile performance rather than first quartile performance followed by fourth quartile. So that was kind of our idea when we put the model together. We made the decision that we wanted to use broad asset classes rather than volatile sector funds or sector asset classes, because we wanted to maintain a static asset mix over time. We did some homework on it and found it was much better to create a model and stick to it than it is to chase last year's hot fund. At NCM, we're a little smaller company, but we really understand that one company can't possibly provide the best solution across all asset classes. So we use a best-in-class methodology, or best of the best, I guess. Whereas most models only buy internal product. So we think that gives us a leg up on our peer group, and you'll see so far the results have been pretty good. We monitor the funds, so we take that away from something you don't need to do. We monitor the funds of the model, and we make changes if needed, whether that be multiple years of poor performance, or basically a manager getting off of what we expect them to do. If a U.S. manager starts buying global stocks, then obviously it's something we might make a change. I think using models, when we kind of look more at the advisor side, using models should lead to consistency of results across your book of business. All your client accounts are going to look the same. And if you get a phone call from a client and you know that client is a balanced model, you actually know the return of their portfolio right out of the gate. Versus, as probably many of you have, every client's, they bring in some funds that maybe you don't support, but they don't want to sell. And honestly, you're responsible for the know your product part of that business. We take all that away. You force the people onto the models, and I think the results, I think, speak for themselves. But consistency of results is really important across your entire book. We work with your compliance department when we create the models and get them to take a look at them. So there's certainly less compliance burden. All your accounts will be uniform. They'll be treated the same regardless of account size, which would be, in the unfortunate event of an audit. It's nice when everything is consistent. We've taken emotion out of the and conflict of interest, I guess, out of the investment process. Sometimes you get to know a manager, and it makes it very difficult to sell their fund if they continue to underperform. We've taken all that away. We've basically looked at the numbers, as Mark mentioned. I try to measure anything that can be measured, and we're continually monitoring and make changes if we need to. The know your client aspect should be satisfied, as in order to go into these models, you answer a questionnaire. Your client answers a questionnaire, which is tailored to meet the client's appropriate risk level, so it puts them in the right fund. So again, we've kind of covered the know your client side. There's automatic rebalancing for those of you that aren't discretionary managers. If you want to rebalance your portfolio, that could be hundreds of phone calls. This is all done automatically, depending on the model, either 4 times a year or twice a year. And that activity shows up on client statements, which those of you who are fee for service, when you send a client a bill and it's a hefty one and nothing happened, there was no activity on the client statement that quarter, they may question why they want to, why are they paying you the fee? And these rebalances actually end up showing as activity, which again will maybe lessen a few of those phone calls. But really, the bottom line is this bottom point. Going with a model portfolio allows you to free up time to spend with existing clients, find new ones, or in a lot of cases, just get a better work-life balance. I mentioned this earlier. Consistency is really the objective for us. But what we did when we put the models together is we looked to maximize risk reward through a diversified portfolio, steady, consistent performing funds. Currently, we run 6 model portfolios for Agora, or 6 families, I guess. 3 of them are active: Tempo, Active, Providence, and Performance. They're about 80% active, 20% passive. We have 2 passive series, Tempo Passive and Velocity, and they're the flip side. They're about 80% passive, 20% active. And we have a low-cost series called Tempo Access, which is really meant to go head-to-head with the Wealthsimples of the world. Again, when we put these together, I'm a believer in active management. And so if you're going to pay for active management, you better get a little bit more. So our best performing series so far have been the actively managed ones. And, the low cost series, you kind of get what you pay for. You pay a little less and you get a little less, but it's certainly less of a headache from a fee side with the clients. In each of these 6 models, we have 5 risk levels: conservative, moderate, balanced growth, and aggressive growth. So in total, we have 30 portfolios that NCM is managing in the Prime Plus Agora platform. Model construction. Again, this is 4 slides, so I'm going to go through it pretty quick. What we did is we looked at the historical asset mix. We spent a lot of time looking at the correlations of different asset classes over time, how often they trend, what happens when they reverse. And we ended up creating a long-term asset mix, which, honestly is probably the most important aspect of these models. You'll see our passive models outperform, as do our active models. And the passive is almost essentially an asset mix call. When after we set the asset mix, again, this is on the active side. What we did is we took the entire universe of funds. We eliminated anyone that had a risk rating of medium or above medium. So all the medium to high and the high risk funds we eliminated from our universe. We eliminated any fund that didn't have a 5-year track record. And then what we wanted to find, I've mentioned it a couple times, I'm going to probably mention it a few more, is we wanted to find consistent years of first and second quartile performance. So if a fund has a 10-year track record, we'd want it to be in the first and second quartile over 8 of those 10 years, not just first quartile over every time period. We want that consistency. We look for multiple managers and multiple fund companies. I mentioned this before. And we're really across, I believe it's 8 different fund families. And we think we really have got the best in class. And we look for different investment styles, so we'll match up growth with value, some large cap, some mid cap. Again, it was important to us to do that. And then, of course, we understand that diversification helps reduce volatility and mitigate single fund risk. And really what we're saying here is if we wanted to own 2 Canadian equity funds, the last thing we wanted to do is own 2 $10 billion Canadian equity funds where their top 10 holdings are the same. To me, you're not really adding any diversification if you do that. They need to look different. So we do spend a lot of time on how funds are correlated and really what's the overlap between the funds or what are their common holdings. We then back tested those. Again, I mentioned this. We looked for common holdings. We looked at correlations, Sharpe ratios, standard deviations, and then we put it together. We ran a test. We made sure certain things like, again, as I mentioned, if you're going to pay for active management, you get better returns. So we ensured that happened. But we also realized that your higher risk levels, your aggressive growth should outperform your balance model. So we made sure that happened. And if we didn't get all the results we liked, we went back to the drawing board, we replaced the fund, and we did it all over again. After doing that, and this is kind of where our ongoing comes, is monitoring the funds. So we're consistently monitoring the funds, and certainly on a quarterly basis, we really drill down and see what's happened, how's a fund done. We're not going to remove a fund for a poor quarter. Frankly, we're not even going to remove a fund for a poor year. Funds that have long-term 10-year, 15-year track records of consistent outperformance will have a bad year from now and again. But we found that they typically bounce back with a bunch of good years after that. It's after a couple of years of poor performance where we may consider making a change. Also, as I mentioned earlier, we rebalance all these models on either a quarterly or semi-annual basis. To kind of get into why we do what we do, I thought we'd just take a simple example of a common investor mistake, which is chasing last year's top performing fund. And this is really magnified on years when we've turned from a negative to a positive year or from a positive to a negative year. So we just went back to a simple example of 2022 when the Canadian market was down and markets were down in general. And we took a look at the CIFSC categories that have more than 15 funds in them. And so in the short-term fixed income and money market category, there's 2 CIFSC categories that meet that criteria. And we took the top performing fund in each of those categories, and we took a look at how they did in 23. So it's only a 2-fund mix here. And what we found was in the short-term fixed income and money market, it actually carried from year to year in this specific example. So the top performing fund in 22 was also first quartile in 23 from both a mean and a median perspective. But when you get to the other categories, you actually see a pretty big difference here. So the top performing fund of the 4 CIFSC categories in fixed income, so this is the top performing fund, not the top performing group. The number 1 fund was actually 4th quartile in both mean and median in 23. Same with balanced funds. There's 7 categories there, and that top performing fund fell to 3rd and 4th quartile. Equity funds, you can see, is 3rd quartile, and sector specific funds is also 3rd quartile. So chasing last year's top performer will often lead to this sort of result. And so we want to be careful that we want, again, back to that consistency of performance rather than chasing. Importance of diversification. I mentioned this before. I take a look at the 2 Canadian equity funds that we own in one of the models. One's the NCM Income Growth and Internal Fund. You can see there the oval, the blue, is the holdings of the fund. And you can see it's more of a small cap balance fund. versus if you take a look at the dynamic Canadian dividend, which is our other holding, you can see it's a large cap, more value-based fund. If you look at the two ovals, there's really not a lot of overlap. They're investing in different parts of the Canadian market. So we have two Canadian equity holdings, and they're not going to react the same. They're obviously going to be a little correlated. They're going to move in the same direction because the Canadian market will either be up or down. But that correlation isn't going to be great because they have different holdings. I think it's important to have this sort of diversification. I mentioned earlier common holdings. Again, I think it's important that we know and understand what the historical overlap is between the funds that we own. So if you take a look here, on the left-hand side, you can see the correlation matrix. We want that to be below 0.9. So we don't want, they're obviously, as I said earlier, they're obviously going to have some correlation. They're in the same market, but we want that to be down a little bit. You can see that most of these here, or all of them, are below 0.9. What's more important is on the right-hand side, the common holdings page. You can see that the biggest number we have there is 0.11. That 0.11 means 11%. So there's 11% overlap, or 89% difference between that and the other fund we're comparing it to. And then most importantly, you can see a bunch of zeros there, meaning no overlap. So when we add a second fund or a third fund or a fourth fund, it's truly helping diversify the portfolio. Staying the course. I mentioned a couple of common investor mistakes. You can Google it, you can live it, but you can see that really a lot of people like to chase last year's hot fund and end up getting disappointed. By having a model, you eliminate these overreacting in volatile markets and truly hope to stop the inefficiency of buying high and selling low. I thought I'd really give you two examples of this. One's older, one's a little newer. I think many of you have heard of Peter Lynch. He ran the Magellan Fund. As I said, this one's a little older. I got these numbers from Fidelity. In 1977 to 1990, so in the 13 years he ran the fund, the average return of the fund was 29% per year. The average investor in those funds lost money. Think about that. If they just held on, they would have made 29% per year, but the average investor lost money. I don't have the exact numbers of the fund, but typically the fund might have been up 50% and money flowed in. The following year was down 20%, money flowed out. Next year was up, money flowed in. Following year down, money flowed out. It's pretty dramatic that you can return 29% a year and the average investor lost money. If we take that a little bit, bring that to a little bit more recent, I believe these numbers are to the end of 2022. Dalbar did a study where they looked at the 20-year returns of mutual funds. I believe it was in the U.S. The average return of the fund that they studied in that time period was 7.43% per year. The average investor in those same funds returned 5.96. So it's about 1.5% less. The average investor made 1.5% less than the average return of the fund in that time period. Again, it really sticks to our philosophy as find a good fund, trust the process, believe that you did the right thing when you found it, and then hold on rather than getting excited on an off year or if markets get volatile. Performance, what I've done here is I'm going to show you the performance of two of our models, or I guess four of our models. And they're the four that have the most assets in them. So they were chosen for a reason. So if we look at our growth models, I took the active, I went with active in this case. We have the Tempo Active and the Providence Growth. You can see they're both first quartile over the 3-year period. The Tempo Active has been around for about 3.5 years. The individual holdings have all been around for, 5-10 years at least. But the model has been active for 3.5. You can see it's a solid first quartile. Providence Growth, we created a little bit later. It's about a year and a half old. You can see that it's above first quartile. So again, everything's humming along as we expect here. If we look at the returns, again, a little bit of a grain of salt. I've heard the old saying, I've never seen a back test that doesn't work, and that's certainly something to keep in mind. So if you look at Tempo Active, those 3-year numbers and sooner are all live. The model has been around. The 5 years are back tested. On the Providence Growth, the 1 year approaching the 2 year are live, but the 3 and 5 years are back tested. But you can see their first quartile over every time period. And certainly if you look at the 5 year, it beats 97. The Tempo Active beats 97% of its peer group, and the Providence beats 100% of its peer group. So far, putting the models together by using a best-in-class methodology has really worked well. And if I look at this, again, what we talked about was consistency. I've said it a few times. Look at the consistency of these returns. They're first or second quartile in every time period, except for the Tempo Active in 2022 was a third quartile year. But other than that, a pretty consistent first quartile across the board with a couple second quartiles. Again, that's what we want. That gives you the good client experience. Next model we looked at was the balance model. We picked 2 of them here. We took our velocity balanced, which is a passive model. Again, it's about 20% active, 80% passive. And then I thought I'd show you what happens when we looked at the Wealthsimple equivalent, the Tempo Access, the low fee model. You end up in second quartile still over a 3 year period. You'll see the numbers are a little bit better over different time periods, but we stuck with consistency showing 3 year returns. And the velocity passive was still above first quartile, even though we weren't paying for active management. The returns aren't as good as the active management, but there still shows our asset mix to be pretty solid. And again, we'll just take one more slide here and we'll show you that the returns over 5 and 10 years are first quartile, and you can see at the 5 year mark, it's still beating 89% of its peer group in our low fee model. And then the passive model beats 98% of its peer group. Again, I can't go through all 30 models. I'd bore you to death. But I thought we'd just show you a little bit of how we've done. And again, it's from picking consistency of returns, I feel. We'll just sum it up right now. I'm running out of time here, so we'll sum it up with some conclusions. These conclusions are all about model portfolios. Forget about ours for a second. Just in general, why we think model portfolios are where you should be, and certainly Agora's models. First of all, you minimize compliance burden. Agora models do that. Advisor created. You got to spend a lot of time with your compliance officer, both because NCM has oversight, but also the company has oversight as to what's in the model, and they've reviewed them already. So in the event of a zero audit, you're going to be a lot cleaner. It's easy. The Agora models are easy to explain to clients. Advisor created may or may not be. I guess it depends on your book of business. Agora models are properly diversified. We use that best methodology. We've removed conflicts and emotion from the investment process. We rebalance back to our target weights on a quarterly basis or a semi-annual basis. And we found that historically that's been a good time to do it. Your book is uniform across the board, which if you are ever looking to sell your book, having a uniform book where everything looks the same will help in the sale process. It's easier for a new advisor to come in, so it'll probably get you a higher sale price. We have a strong historical back record. Our results have been very consistent, and I can't underestimate or underemphasize the importance of the auto rebalance. That you don't have to place 100 to 200 calls, call all your clients, and have them agree to a rebalance. It's all done automatically as part of the model program. So thank you for your time. I'm going to turn it back over to Mark, and we'll get on to the rest of the presentations.
Well, thanks very much, Keith. That was extremely insightful, and it's interesting to see how that consistency of process has resulted in consistent returns as well. So it's nice to see that the process is definitely working. Next, we're going to drill down a level, and we're going to look at what impacts the US election might have when it comes to investing. And in this section, we're going to hear from Greg Valliere, who joined AGF in February 2019 as their chief US policy strategist. In this role, he's responsible for providing insight into how US politics are shaping global markets. Greg brings a unique perspective to AGF with more than 4 decades of experience analyzing policy and politics, providing regular commentary and insight into financial services and investment management, including specialized coverage of the Federal Reserve, economic policy, and politics. Greg has more than 40 years of experience following Washington issues. He's widely quoted in the US media and specializes in coverage of the Federal Reserve, tax and spending issues. And Greg is based in Washington, D.C. So thanks for joining us today, Greg. I really appreciate it.
Well, thank you for having me.
So I think with what's going on in the US, that the US is certainly more prevalent than Canada in the news in a lot of days since the election. So with Trump's victory and appointees, can you tell us what policies are setting up to be the most impactful to Canada?
Well, a lot. We still have to see Trump make all of his cabinet appointments, but there's a lot obviously that will be going on. In terms of U.S. Canada, I would say that energy, as usual, is going to be a crucial issue. It looks to me as if Trump will try to resurrect the Keystone Pipeline. Biden surprisingly has drilled quite a bit, and there's been a lot of production under Joe Biden. So I have a contrarian view that if we continue to produce a lot of energy, and if you guys continue to produce a lot, we might get too much of a good thing. It's possible we could wind up with a glut.
Okay, I appreciate that. Now, there's been numerous news articles over the last couple of weeks about tariffs, and tariffs on Canada in particular is what we would like to maybe hear about. So can you tell us your perspective on where you think that's going to play out and how it may be negotiated and that sort of thing?
Well, Donald Trump has an obsession with tariffs. He wants more. He feels it's good for our economy. He doesn't appreciate any argument that they're inflationary. So he has already threatened to raise tariffs on Canada, Mexico, and China. I think in particular, China is vulnerable. Relations are pretty sour. I thought it was a clever move, frankly, to see Trudeau go down to Mar-a-Lago and meet with Trump. They cleared the air, I'm told. There were quite a few very funny jokes, including one that Canada might get annexed by the U.S. I wouldn't wait for that. I don't think that's going to happen. But I think they had a constructive dialogue. And maybe the tariff will go to 25%, but I have a hunch on some of these tariffs. Trump is bluffing a little. I think he wants to scare people, and then he'll come in with a lower figure.
Okay, so a bit like bluffing in poker. So you mentioned Trudeau going down to Mar-a-Lago. Do you see the relationship between Trump and Trudeau being kind of stronger than it was in previous years?
That's a really good question. I think, as we all know, last year there was a lot of friction between the two countries over how much Canada would contribute to NATO. It looks to me at that meeting in Mar-a-Lago was quite friendly, and maybe some of the ill will that they had last year has dissipated.
Okay, that makes a lot of sense. Now, we've heard a lot of talk about building walls, I think mainly south of the border, but what do you think about border security between Canada and the US? Do you think that's going to have any impacts? Is that going to be a negotiating tactic?
Probably the latter, but I do see that as an issue. I was born and raised in northern New England, and I know people up there in Vermont, Maine, and New York State are becoming apprehensive over immigrants coming through their states going to Canada. So I do think that after all of this angst in the U.S. over immigrants coming up from the South, we may have some issues for Canada with immigrants coming up on their side as well.
Yeah, appreciate that. Now, you talked a little bit about the oil industry and the Keystone Pipeline. Like, are there any other industries you think are going to be key in this in terms of tariffs or perhaps import restrictions, farming, lumber, auto? Like, what are the other industries that could come into play here?
Well, lumber, dairy products always seem to be on the list of things where the two countries don't always see eye to eye. But I think there are legitimate issues as we renegotiate a new NAFTA It's probably going to take a year or so, but they've begun the process. And there will be friction, as always, on what percentage of automobiles are made with U.S. parts or Canadian parts. There'll be issues like that. It's important, though, as people say, oh, we've got this issue or that. It's important to emphasize that U.S.-Canadian relations are fundamentally quite good. Our strongest trading partner. I think all of these issues that may emerge this year can be resolved.
Yeah, appreciate that. So perhaps in terms of trade terms, we talked about the tariffs, the border security, the relationship that Trudeau has with Trump. If you were to take kind of a global view from a Canadian perspective, how do you think that will play out in terms of trade between Canada and the US?
I think it'll be pretty good. I don't see any huge issues. Again, I go back to the Mar-a-Lago meeting as being significant. There's always something. There's always a timber problem, something like that. But I think fundamentally, the two countries are on pretty solid footing right now.
I appreciate that. So we've looked at it from the Canadian side. So you're based in Washington, so perhaps we could take a few moments to get some insights on the US side. So, we're going into a time where Trump's talked about Obamacare. So I'm not sure, perhaps you could start with some comments around healthcare, and we'll kind of move from there.
Sure. I think that healthcare will continue to rise. The stocks haven't done that well, as you know, for the last several weeks. But I think that the fundamentals are good there. I think there'll be more negotiations there. But I don't see that as the number one industry to look at.
Okay, so if we're taking sort of where's the most important places to look, would you say that that's in fiscal policy? Would you say that's in tax cuts? Or perhaps, where interest rates are going? Where would you sort of see are the key areas to focus?
Let me give you my theory for this year in terms of the big macro issues. I think we're looking at a year of fiscal restraint. I wouldn't say austerity, but fiscal restraint is, I think, increasingly likely. We're going to spend a lot less on a wide range of things, maybe even healthcare as well, as we see a takeover in the House and to a certain extent the Senate as well by fiscal hawks, people who don't want to spend all that money this year. And I think that fiscal restraint is quite likely as we head into the debt ceiling fight. Once again, we'll fight over the debt ceiling, and that could take much of the spring. There's also, in my opinion, the possibility of monetary restraint. I think the Fed is all of a sudden looking at an economy that's pretty solid. We all thought in September, October, into November that we'd see lots of rate cuts during the winter. That now does not look very likely. I think the Fed sees an economy that's growing by perhaps 3%. They see inflation that's not in bad shape at all. So I think the Fed goes slow. I think the appropriators in Congress go slow. And I think that we probably will look back upon the last 4 years of the Biden administration as a period where we spent too much money and rates were too low. Now I think we're going to be in the process of reversing that.
Well, thanks very much. So maybe we can move on to a different topic. If we've got a little bit of time at the end, we'll come back to this particular range of topics. But I think what's been interesting, certainly from my perspective, is
something went wrong. Please try again.
Sorry.
That's okay. The government efficiency initiative, and kind of how that might play out. That's something that is interesting to make it as explicit as they have done in terms of who was appointed and the potential outcomes there.
Well, I tell you, I think talk is cheap. I think obviously, what do I know? I don't have the kind of money that Ramaswamy has, or all of these billionaires who are now piling into this initiative. But at the same time, I think they will quickly realize how difficult it is to make dramatic cuts in government spending. We're not going to cut defense in a big way. We're not going to cut Social Security. We're not going to cut Medicare. Maybe there'll be a little bit of restraint, as I said, on basic spending. But when I hear Musk and others say, "Oh, that we can do this pretty easily," I have to laugh because it's a lot tougher. If it was that easy, they would have done it already.
I appreciate that. Do you think they'll try and cut the number of people administrating these programs rather than cutting the programs themselves?
Both. I think there will be layoffs, and that's another reason why I think that this is not a go-go year like maybe last year was. But yes, there will be some federal employees who will be laid off. I think the White House, though, has to be careful in not overplaying their hand. I get the sense that they may already be thinking about overplaying their hand. And I tell you, anyone in Washington who tries to do that usually regrets it.
Okay, I appreciate that. I'm not sure that Trump fits the regular mold, certainly from watching from
Right.
the outside in, but I
Yep.
appreciate the comments there. Now, in terms of foreign policy, we have certainly where I live a lot of Ukrainians,
Yep.
and there's been a lot of unrest in the Middle East. Can you comment on the impact and where you think that Trump might sort of intervene in the Ukraine, and then perhaps we can move on to the Middle East separately?
Big stories, obviously. I get the sense in the last week or two that Ukraine, U.S., Russia are getting a little bit closer. It would be naive to say they're going to cut a deal in the next week or two. But at the same time, I get the feeling that Zelensky is getting a message from his own people who are weary of the casualties. And it's not a shortage of weapons, like planes or tanks. It's a shortage of manpower. And I think sacrificing more manpower is increasingly unpopular in Ukraine. So I think there's a decent chance as we go through the winter that they will begin to negotiate, and maybe it'll be summer before we actually get a deal. But I think both sides are weary, and I do think a truce is likely in the next few months.
I appreciate that. So that was Ukraine, and what about the Middle East? How do you think that will play out?
I'd love to say we're close to a deal, but I'm not sure we are. My sense is that there's still the threat of a guerrilla war in Gaza, involving all of the major powers that will not end anytime soon. I think that the biggest wild card in Gaza, in the Middle East, is Iran. Iran is the great provocateur. They fund Hezbollah, they fund Hamas, they fund the Houthis. And even if there's some progress toward a peace deal, I'm not confident that the Iranians would be a reliable partner in such a deal.
I appreciate that. Now, before we move on to our closing speaker, do you have any other final remarks that you think we should hear, Greg, before we move on?
Yeah, I would just say this, that a year ago, everyone was talking about a recession in the U.S., much lower rates, of all sorts of economic problems. It never happened. This year will go down as a great surprise. I think the U.S. economy is remarkably resilient. And even though I don't think the Fed's going to cut rates dramatically, they do have medicine if they need to. So I am an optimist. I think the economy is fundamentally in pretty good shape.
I appreciate that. I think everyone will find those comments very insightful. So I appreciate your time in joining us today.
Sure.
Hopefully we get a little bit of time at the end for questions, but we'll see as time is definitely marching on. So now let's pivot to U.S. growth investing with Auritro Kundu, who's the portfolio manager of AGF's American Growth and Global Select funds that reside inside the Agora models. Now, he's a staunch believer that innovation can be found in every industry. His investment philosophy is rooted in identifying innovative companies who boast strong earnings, growth, free cash flow, and return on equity. He joined AGF Investments in 2015 and has a Bachelor of Applied Science degree in Electrical Engineering from the University of Toronto and an MBA from the Rotman School of Management. Now, I think I've got a few questions for you. I'm going to skip maybe a couple, but can you cover the key themes within your strategy that maybe including the macro themes as well? So how you're looking at that?
Yeah, so at a high level, our objective is to identify market leadership, right? And how we define that is why I think we're unique. we define market leadership as, companies that are growing, that are the most innovative companies out there. But how we define that is two ways. Companies can be typically growing from launching a new product, growing really fast, entering new markets. But if it's not coming from that, the growth is most likely coming from the macro environment. So we're willing to make those pivots and how we define market leadership. And so I think, the best way to describe that is if you see over the long term our upside downside capture, where we want to participate when the market's doing really well, but we also want to protect on the downside when the market isn't doing as well.
I appreciate that. So you're looking to minimize that volatility in terms of watching that downside capture as well. So I'm sure everybody appreciates that. Now, what industries and subsectors are you paying most attention to at this particular time, and will that change over the next 12 months with the change of government?
Yeah, no, that's, again, market leadership's always changing. So our goal is to change with it. What I'd say is, I'd build on a lot of what Greg said, right? And, at the end of the day, I think the narrative is this is a pro-business kind of, party in the U.S. And so what do I mean by that? If you look at what's leading in the market, it's actually not technology stocks, right? If you look at leadership the last month or so since the election, it's financials, it's utilities, it's consumer, it's real estate. There's been a real broadening of the market under the hood, right? And so if you look at, how our fund was positioned in a market like this, we're overweight financials, we're overweight industrials, where, small caps might do well. You're going through a rate cutting cycle. Financials might do well on this idea of perhaps more deregulation, increased M&A, CEOs have more confidence to do stuff. And then industrials, this idea of reshoring, deglobalization, manufacturing within the U.S. Again, as Greg mentioned, a lot of tariffs, but really bringing those jobs into the U.S. And so we're positioned, thankfully, for a lot of those. But those are some of the things that we're looking at or continue to look at right now.
I appreciate that. So you mentioned manufacturing. Are there any specific industries or any specific companies that you feel are most poised to experience growth?
Yeah, I think one of the best ways to play this is to step back and think about all these big projects, right? Whether you're building highways, building roads, or you're upgrading the grid. In the U.S., you can make the case that it's an underinvested fixed asset base. Ever since China joined the WTO, you had this idea of reshoring and globalization. Now you're undoing all that. So how do you create the grid for wind, solar, and now even nuclear? You're going to need more and more nuclear to power things like generative AI. So when you think about all these projects, it's not the utilities that do these projects. I know I mentioned a few utilities. We own a few that are tied to more of a nuclear stance, but there's a way to think about this as the picks and shovels. Who are the companies that are providing the labor and the tools to do this? So we own a company called Quanta Services, ticker is PWR. This is a company that comes in and does a lot of these renewable projects. They have a 3x labor advantage than their nearest peers. So when a utility wants to put, let's say, DC power lines underground to prevent fires, like PG&E in California, they're the ones that'll do this project. So again, when we think about it from that lens, who are the kind of picks and shovels that are doing these projects?
Hey, appreciate that. Now you mentioned, as part of your previous answer, you mentioned AI. So from that perspective, we've seen what's happened with NVIDIA. What do you see looking forward in terms of the technology sector, in terms of how AI may continue to impact there?
Yeah, so this is something we're very excited about. Our general view is that you're at the ground floor of something that's going to be very big. And what I mean by that is, if you look at kind of big tectonic shifts historically, when I was an engineer, it was when the smartphone industry came up, moving your PC power to the smartphone. When I started on the buy side, it was this idea of cloud computing. If you've been working long enough, I'm sure you remember when your server was in the kitchen. Now you move that to the cloud, and you freed up your capex for opex. And how I like to frame it is those are distribution model changes, right? Those changed how and where you access things. Generative AI is something completely different. You're training these models, ChatGPT 3 going to 4, you have Gemini from Google, you have Llama from Meta. You're getting more and more parameters, meaning more and more data points, and these models are becoming bigger. They're becoming better, right? Going from 170 billion to trillions of parameters, right? And so what we're all going to end up having is our own AI assistants, right? So we're just at the surface. You're using some consumer apps right now. We'll eventually be using this stuff at work. One of the things NVIDIA talks about is sovereign. Every country now has to think of their military strategy, right? Then enterprise. Every enterprise companies have to think of what they want to do with their data and how they're going to reach out to their customers. So I still think we're at the inflection of something that's very big. Now, we can debate, the pace of capex, meaning companies like the Metas, the Googles, the Amazons of the world spending on these kind of GPUs to train models. But at the end of the day, even if there's some, I guess you could say false starts or maybe some air pockets, I think long term, if you listen to what these companies are saying, it's two things. They would rather overinvest than underinvest because they think this opportunity is massive, right? And secondly, there's something that NVIDIA talks about called scaling laws, where it's getting harder and harder to efficiently and better train these models to keep that cadence going, right? If you're training a larger model, is it getting smarter? And so how do you keep that cadence of innovation going? So that's something as well that's going on in the industry. But all in all, as you mentioned, NVIDIA, it's our largest holding, and it's going into a new product cycle. They're innovating faster than before. They're launching a new product every year versus two. They're going into a ramp of a new product, which maybe impacts margins in the beginning, but by next year, this is going to be something that I think is already, supply constrained, and everybody's trying to get their hands on. So we're still believers in the theme. We have exposures in it, and I'd say it's still early days.
Mark, a real quick comment, if I might, on AI. I think the regulatory climate here in Washington is remarkably gentle. I don't see a harsh regulatory response at all. Most people in Congress don't have any idea what AI is. So I think the industry gets almost a free pass from a regulatory standpoint.
I appreciate the additional insights there. So next question is, when I was talking to Greg, we talked about tariffs. How do you think, like at the fund level or at the investment level, how do you think that's going to impact things like the Canadian dollar, interest rates, those types of things, exchange rates? Just how's that going to play through?
Yeah, so this is interesting. I mean, some of the biggest items that we export, and just to build on what Greg was saying, whether it be autos or energy, these supply chains are really intertwined. So a lot of these costs may be passed on, and that's why you might even see pushback, lobbying power in the U.S. You've seen Walmart come out and talk about prices going higher for their consumers. So there could definitely be some pushback here, where perhaps there is a case that, and look, it's early to say that perhaps the tariffs don't play out like we think. And let's just say in an instant, let's just play the scenario out, and then I'll bring this back to Canada. There is a case here where Canadian GDP could accelerate, right? So, you're coming off a 2024 level of 1.1, 1.2% on, GDP on Canada. Our rates are going lower. Our inflation is about at the 2% target. BOC, it looks like the expectations are for a policy cut to about 3.25. Now, if you don't get tariffs and growth accelerates, think about everything we're talking about, manufacturing and kind of global supply chains. And if growth actually accelerates, especially in North America in general, then you can get a case where Canadian kind of GDP accelerates, plus inflation's intact. So ultimately, there's a case that I'm not going to make a call on this, but perhaps where the CAD dollar has, or the USD CAD has run here on this $1.40. Perhaps you start to see a recovery the other way. So in that case, maybe you get back to that mid $1.30 level, and we've kind of played this out. But of course, if tariffs go to 25%, perhaps $1.50 on USD CAD's in play. So in general, to my point, there is a setup here that potentially, if we get through this and tariffs aren't as bad as we think, our GDP can grow, inflation's intact, and perhaps it could be good for our stock market and currency. Oh, hello, Mark. I think you're on mute.
That was my. So final question to you before we kind of bounce it around between the other presenters. If you're looking out the next couple of years as a growth investor, what future themes are you monitoring that perhaps you're not including today, but have kind of in your peripheral vision?
So a couple things there. I'd say firstly, just in general in the markets, and I know we touched on this, markets are making all-time highs, and I always get the questions, where can we go from here? You're in the third anniversary of a bull market. We've gone through 2 years. From the bottom of this bull market, you're up about 60-ish%, which is actually in line with the historical bull markets. So this isn't a melt-up scenario that we've seen. The average bull market's about 5 years. So I think there's a way to go. Now you're in the third year of this bull market. Perhaps this year gets a little harder. And what I mean by that is, look, valuations have run, right? So you've gotten to a point where the S&P is at maybe 22 times, but the equal weight is at 17, meaning the average stock is not that expensive. And perhaps you're seeing some deceleration in the Mag 7 names. You're seeing an acceleration in the rest of the market. And the point I'm trying to make is, and I think Keith said this earlier, is this broadening of the market is good for active managers. So we see a lot of opportunities where what's really important to us is focusing on those companies that are beating and raising, focusing on those companies that are growing revenue, growing earnings, but beating those expectations. And so, tying that into your original question, again, AI, I think, is a fantastic, opportunity. I think healthcare, you have the largest drug category of all time, but there's so many other great things happening, especially in the med tech space. That space in general, it looks relatively inexpensive. Reshoring, deglobalization, a lot of opportunities, industrials. And then just for me, a lot of things that I'm looking at, I'm looking at drone technology. There's a company we own called Axon. It's a play on public safety. And they've, started with tasers, body cams. You may know them from that. They got into software. They're leveraging that to have AI tool capabilities in their products. But now they're, investing in other things. They have Axon Air and drone. So, my wife works at a hospital here, and so I was talking to somebody in the emergency task force, and they were saying Axon's amazing. I get all my products for them. I can't get off that. But B, he was saying I'm playing with drones. Like there's different kind of warrant issues if you're flying a drone in or out around a building. But again, as we mentioned, just tying this into what we're talking about in Russia, Ukraine, and what's happening at the border, and how this war is being fought, perhaps with $400 drones and some software rather than fighter jets. So what does that future look like? So that's one area, drones, robotics, I'm pretty fascinated about. In general, one other area, don't have exposure yet. We're doing a lot of work on space. You're seeing a lot of companies launching rockets. You're seeing a lot of LEOs going to space, Starlink. Amazon's going to have a product called Kuiper where you're giving internet services. And in general, from a security perspective, having more and more satellites. So that's an area we're spending more time on that I think investors will talk about a lot this year.
Yeah, no, it's crazy the developments that we've seen over the last number of years. My cousin works for a satellite startup. He was one of the founders, and they sell the images to investment firms so that they can kind of see what stocks are out there in terms of cars in parking lots, or the density of the liquefied natural gas storage tanks and all of that. So it is absolutely astounding where we've come. So you mentioned inflation there. So I'm going to turn it back to Greg. We've had a couple of questions come in. And Greg, how do you think, if you could maybe drill down on tariffs and how that might impact inflation? That's one question people are looking to get answered.
I think quite obviously you'll see the price of things go up if we have aggressive tariffs. Hopefully Trump wouldn't go to 100% with China. I think that would be a real headwind for global economies, really inflationary, and would lead to retaliation. So I hope we don't see that. There's only one inflation story that really keeps me awake at night. That's wage inflation. I think it hasn't gotten enough publicity. You look at the Boeing settlement, you look at the longshoreman settlement, you're still seeing wage inflation above the Fed's target. It's close to 3%. But otherwise, I think inflation has started to behave.
I appreciate that. So next question I'm going to direct to Keith. So we've heard quite a bit about the story in the U.S. Has what you've heard today had any impact on your, I'm going to say, your long-term asset view? You've always been a big proponent of U.S. investments. You hold it at a fairly significant weight in the managed solutions. And has anything that you've heard today detracted from that story?
And no, I mean, as I mentioned, I'm mostly a static asset class holder. I do have a significant weight in the U.S. I do think that's where the best companies are, the fastest growing companies. That'll continue. I think at the margin, the question is Canada versus international exposure. And, I'm a little more biased to the Canadian side, not just because I run a Canadian fund, but historically, I've found that the Canadian market has outperformed the international markets. And, believe it or not, the Canadian market's been more consistent than markets, even though people think of the energy positions and volatility in Canada. But if you look at the 10-year number in Canada and the 20-year number, they're pretty much the same, through the thick and thin of oil prices. So You know what? It's always worth knowing. But again, we kind of made the philosophy went in that we didn't want to chase something. I found that time in the market is tough. You can get it right on occasion, but I'd rather stick to an asset mix that I'm comfortable with to work over 5 years. You know, keeping in mind, you know, for Auritro as a portfolio manager, he's going to be judged from month to month or quarter to quarter. So he has to make a few more calls. But from a model portfolio point of view, we're really looking for a solid 5-year return, not too concerned about what happened yesterday or next month. So it really isn't something that I'm not going to lose too much sleep on. I think we've done the work. We love the asset mix we have. You know, there may be an opportunity to change at the margin, but it would be minimal.
Okay, I really appreciate that answer and everybody's time today. So I think everybody would agree that we've had a fascinating discussion today with some really great takeaways, and really appreciate everybody's insights, from Keith at the top level, through Greg in the focusing on the US, through to Auritro, who's focused on the specific fund management side of things too. So it was interesting from my perspective to hear 3 different levels of analysis on the same call, and it was also interesting to see the consistency between everybody's opinion at different firms and at different levels as well. So if you would like any more information on the Managed Solutions program, please reach out to myself, Mark Probin, and you can do that at mprobin@agoracorp.ca. And if you're looking for some more insights from Greg, you can subscribe to his blog, which is found on the Insights section of AGF's website. I'd like to thank everybody for attending today's presentation. And if you've got any ideas for future calls, really appreciate it if you can send them to myself, and we'll tee those up. So thanks for attending, and have a great day. Thank you very much.
So long. Thank you.